we all seem to be a big fan of Queensland, right? Then we sort of look through the statistics and we're saying that whether Brisbane really has done much so far. How important, I suppose, is diversification, Paul? And so if I'm an investor, which I already have a whole bunch of properties in Brisbane for that matter, what are the other markets that I should be looking from a diversification point of view, and how important it is?
Yeah, look, I think diversification is a pretty sexy word when it comes down to property, for the fact that sometimes I think people confuse it with boredom. And I think to a degree, there's only ever going to be a small amount of markets which are actually going to perform in a finite period of time. Australia doesn't move in a linear line, we move in different market cycles, and it's going to be based on a whole bunch of different trends that we've already discussed. Factoring in diversification, I think there's a few things that we always consider with our clients who probably end up with multiple properties in a portfolio. For us, it comes down to what have they bought at what time in that market in particular. So things such as state-based land tax, it's a state tax in this country, and obviously understanding how that affects overall investment strategies, cash flows, etc. I think that's where a good accountant gives advice before purchases are made, as well as what the strategy is for the next purchase, understanding what your thresholds are, personal names versus trusts versus superannuations, etc. Also from us, it also looks like making sure that when you've got a certain amount of exposure, that effectively that exposure isn't there because you're trying to jump on the back of potentially bandwagon buying. And that can be sometimes when we look at potentially people who have bought in Sydney as an example, or Melbourne as an example, probably over the last 18, 24 months, where it's probably bought too close towards the back end of the boom to really see true growth in this cycle. And they've probably now, truth be told, got 7 to 15 years if they've bought buy and hold strategy properties for that property to really mature and do its work. So diversification in that sense, if that's your only play and you're really sitting there fingers crossed that that's going to work, then you really need to look at saying, if you're waiting there expecting what happened in the last 5 years to happen in the next 5 years, you're probably going to wait twice if not 3 times as long. So diversification for us allows our clients to get exposure into markets, to get different growth cycles accessed, as well as getting opportunity to also get opportunity for cash flow if need be, whether it's a cash flow play, capital growth play, development play. But on top of that, I think, and this is something you speak a lot about, Munzrel, and I, over the years I've known you speak about this part too, and I've learnt this from a lot of investors that I work with, that the best investors I know understand that property in isolation is quite risky. If you've got one property, you've got 100% exposure in one property. If you've got 2 properties, you've got 50% exposure in 2 properties, so on and so forth, where it doesn't mean that 50 properties is really what the target is. However, there is some safety or comfort in numbers, whereas if you've got 5 properties, 1 is vacant, you've got 20% vacancy rate. If you've got 10, you've got 10% vacancy rate. So there is also some backstops you have in play, as long as those properties have been purchased with the right rationale in mind. So I think it also allows you to be comfortable being uncomfortable. So debt becomes really good debt when it's exposed to multiple assets as well, because it's not all the eggs in one basket, so to speak.